Today we're going to be exploring the best loan options for first-time homebuyers in 2024. As a first-time homebuyer, think of yourself as the CFO of your own financial house. Just like Chief Financial Officer in a company oversees financial actions, you'll need to manage important aspects like your loan balance and interest rate. What's up, guys? My name is KMAC, and I'm a licensed real estate professional in the Dallas-Fort Worth area and the Orlando, Florida market. And in today's video, we are going to be discussing the best loan options for first-time homebuyers. But before we get into today's video, if you are finding the content on this channel useful, please give this a like, subscribe to the channel, and turn on notifications to always be notified when I release another video. Now, a typical mortgage payment includes several different components, meaning the principal, interest, taxes, and homeowner's insurance. And of course, depending on how much you put down, mortgage insurance as well. While the principal and interest directly relate to the loan, the other components like taxes, insurance, and PMI, property mortgage insurance, are also crucial and can vary drastically. For example, property taxes can significantly affect your overall monthly payment. Now, a house with a $3,000 annual tax bill adds about $250 a month, whereas one with about $5,000 may add closer to $416 a month. So choosing a home with lower taxes can save you a substantial amount each month. I actually had a client just reach out to me yesterday regarding this particular situation. Now, this is a little bit more complex, but I'll give you a breakdown of what we're dealing with here. Now, this particular client purchased a more rural home. The rural home was on significant acreage and hadn't really had any substantial growth in terms of the taxable value that the county assessed in, gosh, maybe 5 or 10 years, but this particular client decided to purchase the lot. Now, by purchasing this home as a secondary home and actually kind of living back and forth between two houses, here in Texas, we have what we call a homestead exemption. A homestead exemption is essentially something that you can apply to a primary residence, and it will limit essentially what the county can do in terms of raises on your property taxes. Now, this particular client already had the homestead exemption applied to their primary house, which made the county for that secondary house have free rein to essentially increase their taxes to whatever the county deemed that property and land was worth. Now, this client purchased this house and lot for about $350,000. Now, also, if you're familiar with the Dallas-Fort Worth area, which is the market that I serve, the values here have continued to climb, especially in Dallas County. Well, this particular lot was slightly outside of Dallas County and Collin County, but just like Dallas County, Collin County has also seen a significant amount of increases in property taxes. And because there was no homestead exemption, her taxes went from being essentially assessed at $200,000 to now being assessed double at close to $400,000. Now, the prior owner had had a homestead exemption applied to this acreage in Collin County, and because of that, it was only really tax assessed at $200,000. Now, because my client purchased the property and didn't apply a homestead exemption because she had it on another property, the county was like, okay, this is my opportunity to really bring that assessed value up to what is a realistic price for the market. Now, that realistic price is close to $400,000, and now because of that, she's essentially paying $500 more a month, not in a year, a month, on her mortgage payment. Obviously, that's going to be a pretty significant chunk of change. Most people don't want to be told, hey, this is a property I own, and now you owe $500 even more a month added to your mortgage. So in regards to property taxes, regardless of which state that you're looking at, make sure you're doing your due diligence and make sure that you're going at it the right way with kind of the right people representing you, whether it be your lender or your real estate agent, to make sure you're not going to be in that same pickle as she is right now. And just a side comment, I did not help her purchase that house. I'm actually going to more than likely help her sell it because it no longer makes sense with how much more money she's paying in taxes. Now, home insurance is something that absolutely pisses me off. No, I'm just kidding. Well, it kind of does because it's just insane here in Texas. But home insurance itself can be negotiated. I highly suggest that you look kind of for an insurance broker. But mortgage insurance, or PMI, varies by loan type and can significantly affect long-term costs. Now, there are two main types of mortgage products: government-backed loans such as FHA, VA, and USDA, and conventional mortgages. Now, government-backed loans are designed to make buying a home more accessible and usually more lenient on qualification requirements. Now, conventional loans are not government-backed loans and often provide better terms for those with higher credit scores or possibly larger down payments. Now, if you don't already have a mortgage broker or a recommended loan officer that you're working with, make sure that you're doing your due diligence when it comes to actually interviewing and speaking with different mortgage brokers, banks, or loan officers, because every single loan officer is going to be able to provide something different, a little bit here or a little bit there, but all of them should be able to provide these two types of loans, meaning conventional loans or government-backed loans. So for first-time homebuyers, the FHA and conventional loans are typically going to be the most relevant. FHA loans are essentially appealing if you're still building your credit or you have a lower credit score, as they require smaller down payments and are easier to qualify than conventional loans. Now, conventional loans on the other side might be a better choice if you can provide a larger down payment, potentially avoiding mortgage insurance altogether if you do put greater than 20% down, which saves money in the long run. Now, one thing that I want to preface here is stating that the FHA loan is not a negative loan. It's not a bad loan to get. Let's put it this way, it's a bad loan to hold long term, which I'll explain in just a second, but it is not a bad loan to get altogether. More than likely, you need to speak with your loan officer or your mortgage broker or your bank and have them walk through why an FHA loan makes sense over a conventional loan, or vice versa, why a conventional loan makes more sense than an FHA loan. Now, one thing I will say about FHA loans is the property mortgage insurance that you incur is going to be greater than the conventional loan. Now, on top of that, it never goes away. And that's the downside about an FHA loan, is the property mortgage insurance, again, does not go away. Now, on the flip side, with a conventional loan, once you get to 20% equity in the house, or if you put a 20% down payment, you won't even have property mortgage insurance. It'll essentially fall off. Or again, if you put a 20% down payment, you're not gonna have it to begin with. Again, the FHA loan though, you're gonna have it for the entirety of the loan. So a lot of the times what happens is individuals will get an FHA loan, they'll make payments for a good bit, maybe a couple years. Down the road, if rates get better, hopefully not worse, you'll refinance to a conventional loan that makes more sense. But be cautious about non-qualified mortgages, which are meant for unique financial situations, but might come with higher interest rates or less favorable terms. And also a big one that I get asked a lot are these down payment assistance programs, which can be helpful, but they are not a separate category of loans. They simply just add specific conditions to standard FHA or conventional loans. Now, the downside with down payment assistance programs is they gotta get their money somehow, meaning if they're taking the risk on you and you don't even have a down payment, usually it's going to be an FHA loan, but an FHA loan's already going to have a high property mortgage insurance, and they're still going to have to get that extra $5,000 or $10,000 from you somehow, because they're fronting that essentially as your down payment. So your friend over here who has a conventional loan at 5.5%, you may be looking at 8% for your FHA loan, because they know eventually you're going to pay back all of the money that they gave you up front and then some. So which loan is easier to qualify for? Well, generally, as I mentioned before, an FHA loan is going to be more accessible because of the lenient requirements. However, they come with permanent mortgage insurance, as I just mentioned, which can add to a cost long term. Now, conventional loans might require a higher credit score, but offer significant benefits, such as the possibility to cancel your mortgage insurance once you build enough equity, as I just mentioned, and this can also result in substantial savings over the life of the loan. Now, just to give you guys a number, let's say on a conventional loan, it's $200 a month in property mortgage insurance, and the FHA loan is going to be $350. Well, using those two examples, you're roughly going to be spending about $24,000 in property mortgage insurance. I know with a conventional loan, it will scale down over time. So over the course of the next 10 years, if it takes you that long to pay down 20% equity in your house with that conventional loan, yes, ballpark numbers, you're going to be spending about $24,000 in mortgage insurance. But with the FHA loan, you're paying more. You're paying $350. So over the course of that 10-year period, it's going to take you not $24,000, but north of $40,000 in property mortgage insurance that you pay to get yourself down to that 20% equity. Now, again, the key saving factor here is a lot of loans don't actually last 10 years. The average note or the average mortgage lifespan is only about 8 years. That means people either sell the house, they relocate, and maybe they get the loan assumed by someone else, or which happens most of the time, is they refinance, which with an FHA loan, just know if you're going in the door with an FHA loan, just plan to refinance down the road. Now, when deciding between the two, consider both your financial stability and long-term goals. Now, FHA loans can be a great starting point if you're new to credit or need a little bit more forgiving loan due to a lower credit score. But on the other hand, conventional loans are ideal if you're aiming to minimize future expenses and possibly pay off your loan faster without the burden of mortgage insurance. Now, choosing the right mortgage as a first-time homebuyer involves balancing your current financial situation with your future financial goals. Whether it's an FHA or a conventional loan, ensure it aligns with your financial plans. Always consult with a financial advisor or mortgage professional to make the best choice for your specific circumstances. Now, one thing that I will say, and this is not financial advice, and this is obviously not coming from a mortgage professional. I am a real estate professional. I'm a realtor, not a mortgage professional or loan officer. But for the most part, I would always suggest if you can qualify for an FHA loan, but maybe you can't qualify for a conventional loan, purchase the house if it makes sense. Meaning, if you're going to be utilizing the FHA loan, maybe to house hack a duplex, wholeheartedly get the FHA loan and down the road refinance to a conventional loan. And also on the other side of the spectrum, if you can't qualify for a conventional loan on a single family house, or maybe you're looking to just purchase a house for the first time, you don't have the best credit, you don't have a ton of income, maybe you require a down payment assistance program, go and take advantage of the FHA down payment assistance program or just the FHA loan as a whole, with the intention down the road to improve that credit, improve the equity that you have in the house, and eventually transition over to, or I should say refinance, into a conventional loan. And the goal should also be to hopefully get to that 20% equity so you really start to save money by eliminating that property mortgage insurance. Now, if you have by chance watched the entire video up until this point and are still curious about which direction you may want to head, well, here in Texas, which is where I operate out of the Dallas-Fort Worth area, my best friend owns one of the top mortgage companies in the entire state of Texas. Technically, he's got recommendations and referrals across the entire country. So if you're in Texas or you're in really any state in the entire United States, I can get you connected with a great lender and really walk you through which makes the most sense for you. Now, if that is the case, make sure to leave a comment in the comment section down below or reach out to me via the description below. You can find my Instagram, Facebook, or my email address where you can reach out to me directly. And that's all I got for you guys this week. Thanks again for watching. Make sure to like and subscribe. It really does help. And stay tuned for the next video.